I think like 85% of the guys who are invested are just ChatGPT.
The mistakes in the stock market continue to remain the same, just the people keep changing.
We are not looking at all that data today, right? Today, all we're looking at is news, TV channel, or looking at Twitter posts and deciding that, today it's all bad and, markets are going to remain bad.
Maximum wealth we've seen is made by stocks when they are in their growth phase.
You always have to evaluate growth versus price together. You can't have it in isolation.
When does that growth turn into an excessive optimism?
No one, even the promoter, cannot tell you what's going to happen, say 5 years, 6 years, or 7 years out.
A lot of the investors, think, let's buy whatever has fallen the most.
Everything depends on your ability to predict future earnings growth, right? And if it's hard to predict earnings, you would want to stay out. Generally, when we are looking at something like that, we are looking at some sort of trigger in earnings.
So where does the risk start? Welcome back to Leverage by Qode, where quant thinkers take the mic and decode the markets through a sharper lens. In our last episode, we explored market regimes. This episode is about growth investing, and specifically when it becomes too expensive. This conversation is about discipline over excitement and about why the most dangerous investments are often the ones that feel the most obvious. And to discuss this topic, I have Gaurav and Rishabh, our fund managers, here today. So really excited to get into this one.
Thanks for having us, Pradeep.
Thanks, Prateek.
Yeah, so the first question is that maximum wealth we've seen is made by stocks when they are in their growth phase. Now, my question is, when does that growth turn into an excessive optimism and that stops working?
There are different approaches in investing, so one largely accepted approach is, GARP or GARP, which is growth at reasonable prices. There could be a company that's trading at, let's say, 70, 80 times, earnings. It's possible that still is a great company to, invest in. But the idea is you always have to evaluate growth versus, price together. You can't have, it in isolation. There's also another thought process, picking companies, which is buy at any price, or as loosely people call it BAAP or BAP. So what we have tried to do is historically we have tested these things out, how generally these things play out. And the thing is, if you're, just buying at any price, you won't be able to see that upside in your portfolio over a long term.
So I think it's a valid question because, we saw this like different periods, right? Specifically in 2024 when, we were extrapolating into the next 5, 6, 7 years, right? And I think this happens a lot when prices start moving a lot. So 2023-24, Nifty was up significantly, small caps, mid caps were going through the roof, business were running at 70, 80, 90 times earnings, and everything was being justified. And I think you can very clearly see the emotion out there. You can see where people are, paying in excess. Now, when you're in that moment, it's very hard to sort of distinguish whether, is this reasonable or not. What we end up doing ourselves at Qode is that we take a step back and see the entire picture. Look at the cycle, look at 10, 15, 20 years of data and look at where we are today in terms of, say, price to book, price to earnings, what has happened when you're paying these kind of prices, right? It's not that hard. It doesn't have to be that challenging. It's all about just figuring out, okay, fine, you don't want to overpay or you're not okay to, enter at these valuations even if the growth comes. So there are cases where, you can see that crazy growth for 2-3 years and you might miss that rally or you might miss the bus out there because, you're not willing to enter if there is no margin of safety. So I think, that those periods are there. As we speak today, 2026, I don't think so we are in that zone anywhere. I think people are now sort of, a lot of the corrections happened in terms of valuation, specifically in the micro and the small cap space, right? So today we are well below the median, price to book, price to earning numbers for most small cap businesses. So I think, today that is not there, and you can see the emotion also, right? How people are moving away from equities thinking that, we've not made any money. So,
Right.
Yeah.
When someone is chasing growth, are they paying for poor business quality at the top, or is the market seeing that maybe this business will make no mistakes for the next 10 years? That's the kind of projection people make when, the growth gets really excessive.
I'll tell you, the idea is to separate out, two things. One is the underlying business, and second is, the price that's being paid for it. Let's assume that if the businesses, weren't valued on a day-to-day basis, there's no stock market, trading and all of that, you'll assume the company to, go forward in a particular way. Now that is dependent on their business, dependent on, let's say, the products that they're selling and all of that. Now there comes an angle which is valuing the business on buying and selling securities in the market on a day-to-day basis. What happens over here is that maximum liquidity gets driven towards highest certainty of revenues, or highest certainty of growing profits. What happens is, let's say if there was a company trading at 20-25 times P, now people see that this company has the potential to, let's say, double, triple, quadruple in the next 4 to 5 years. Maximum liquidity gets driven towards this stock. As a result, what happens is the stock price goes up. Every stock price that goes up means that the return for the next investor is going to be slightly lesser, and liquidity flows in such a way that doesn't have to always generate that return for you. It's possible that a company continues on the growth path that it had mentioned. Let's say the company did double, triple, quadruple over the next 5 years. It's possible that the investor has not made money because they entered at absurd valuation. So I would say the idea is to be able to play that game, being able to understand that what is the margin of safety, how much can I assume the stock to go up from here. I'll give you an example also. There's the stock that we've been tracking closely. Now the company said that the revenues are going to double over the next 12 months, and the revenues doubled in 9 months itself. But we have seen a 40% correction in the stock. The P went from close to 30 to close to 10 right now. So what happens is, it's also possible the company continues the path that it was in, but the market now starts looking at it in a different way, because maybe now they're seeing a different 5-year, a different 10-year ahead for that specific company also.
Going on what you just said, when do we realize that this particular stock or the way it's valued has crossed that line? Right? So where does the risk start becoming imminent? What we can look at to understand that that entire growth thesis is already factored into the price, and for the new shareholder or the new investor, there is no much upside even if the company ends up growing.
I think, see, it's pretty simple, right? Like everything depends on, like if you're making a financial model, everything depends on your ability to predict future earnings growth, right? Now, no one, even the promoter, cannot tell you what's going to happen, say 5 years, 6 years, or 7 years out. So what you can look at is, say, 2, 3, 4 years. Generally, when we are looking at something like that, we are looking at some sort of trigger in earnings, which is not factored into price. We are trying to say that, okay, fine, there is going to be some, big trigger in the next couple of years. Now, when you're making assumptions in a model, right, what you want to take is a very safe or a base case, wherein that, okay, fine, you have a lot of margin of safety. Even if the company does not, is not on track to give that bumper earnings, or, the trigger doesn't come into play, you don't have a lot to lose. These kind of opportunities are rare. That's why on our end, what we end up doing is, for us, asset allocation becomes a very important play, where you're looking at where the broad market is, and it becomes very easy to fish. So you're looking at, where, which waters are, filled with fish, and you want to just go down there and then start fishing, because you're not then so concerned about that particular company alone, because it's going to be hard, right? Like in 2024, it's hard to look at anything at a cheap valuation. But today, if you go out there are ample businesses available at much better valuations with better prospects also. So yeah.
If we take Nvidia, which has grown at more than 50% at that base, at a $4 trillion base, versus a company which is in a sector and it's not the biggest player, it's the third or the fourth, which is also growing at 50%. My question is, do you value the same 50% growth the same way, or do we look at it differently when we are valuing that growth?
Specifically in case of Nvidia or any Nvidia or anything in that sector, which is AI, right? I think it's hard to predict earnings, right? And if it's hard to predict earnings, you would want to stay out. If you are really an expert and you actually understand the sector way more than everyone else, I think like 85% of the guys who are invested are just ChatGPT users, and they've used it and said, okay, fine, this is revolutionary. But there are like multiple levels to understanding that, okay, fine, what's going to happen to something like Nvidia, and like how it, it can move from there. And technology is rapidly changing. So if you can predict earnings, then I think even if it's a small business, you can give it that same multiple. I think, it should not be relative to, okay, fine, it's like the, maybe the 10th largest business in that sector. Should it be compared to Nvidia? I think it should be looked at first independently, that, okay, fine, can it get this kind of an earnings multiple? If Nvidia is getting an earnings multiple, it is for a particular reason, not because the other businesses in that sector are getting. As analysts, we end up looking at it because we are looking for reference points. Oh, like, this business is getting this valuation, so I should also value my business based on that. But I think so that's just a reference point, should have a small weightage. At the end of the day, you have to figure out within your business, what is the, what's the earnings growth and your prediction power. If you're not able to predict, you stay out, or your position size then reduces out there.
Absolutely right. I think I would just add here. So let's say again talking about that example of Nvidia versus really small company. So it's not. I would say size is one of the factors, but eventually broadly what we're looking to do is predict the certainty of revenue. For example, if the smaller company has better certainty of that growth, then we feel that the multiples for that company should be high as compared to Nvidia. But if the certainty of that growth is not there, then even if the company is growing at faster rate than the industry peers, might not really get that kind of multiples. So there's some sectors that we are tracking. That sector is currently, let's say, playing out in India, but it has already played out in other countries in the world. And people have seen that you might see growth till a certain point, but after that you start seeing degrowth or absolutely no growth from there. So people are picking the certainty, or I would say lack of certainty, from international markets and trying and applying that value here also. So I would say in the end, the main reason for us to pay a multiple to a particular company, whether high or low, is on the certainty of revenue and net profits going forward.
In every bull market, there are certain sectors and certain stocks that become really popular, and markets keep making these mistakes, and where they chase into these stories and buy into these themes. What mistake are investors making, and how they can avoid from getting into these growth traps?
I think like it's very much emotion driven, but at the same time, how do you keep your emotions in check? So what we end up doing internally is that you have some broad metrics and start tracking those metrics. So look at 10, 15, 20. So you always zoom out. You don't zoom in, because when you're in that situation, you feel like today as we speak, we're in a case of, like, you're in a situation of war. So you're seeing this entire conflict happening. Markets are reacting on a day-to-day basis. Today markets are down say 2-3%. Overall Nifty is down 10-15%. And then we start extrapolating this data into the years that are there to come. So we start looking at, if there's going to be an LPG shortage and if it continues for 2 months, then the next 5 years is going to be really bad. What you want to do to take an objective decision is go back, look at this data. Okay, fine, what happened during, say, maybe a Gulf War, the Persian War, or when US bombarded Iraq? What happened in those scenarios? How long did this conflict go on? How did markets react? So I think when you look at it from a broad perspective, it becomes a lot easier. Now, for example, if you look at most wars, post-war, inflation goes through the roof. So the chances of markets doing well become actually a lot higher, because there's going to be a lot more money supply, interest rates will drop, inflation will go up. So but we are not looking at all that data today, right? Today all we are looking at is news. Say you're looking at a TV channel or looking at Twitter posts and deciding that today it's all bad, and markets are going to remain bad. So from an investor perspective, I think the best thing is to zoom out, look at a broader view, look at 5 years out, and I think you'll get a much clearer picture.
There's a famous saying in the stock market which says the mistakes in the stock market continue to remain the same, just the people keep changing. So you'll see that every 5-10 years, there are different people who are seeing this cycle for the first time, and they're making that mistake again, being in the market for so long, we feel that there is an element of market timing. But again, after spending this time, we've also realized that nobody can time it perfectly, though you can keep looking at allocation within your portfolio, try to do it slightly differently. If you just talk about, let's say, 10 years back, the quantum of people who are investing in the market, look at that quantum today, you'll see that the largest portion of the people who are in the markets today weren't there 10 years back, and they've not seen those cycles, whether it could be 2018 small cap crash, or 2020 COVID crash. They've not seen those cycles, and then for them it's a surprise. And when it's a surprise, all the emotions come out. When the market is down 2%, you expect the market to go down 10%, you end up panic selling. And then when the markets maybe start running after that, you end up buying it thinking that you might lose out on that particular cycle. So these mistakes continue to keep happening, but just with different people. I think what makes sense to have is broad 5-10 year framework, saying that if liquidity is at this level, or if it's at this level, what is my action going to be? and you can see historically if that process has worked out for you. If it has, then you can just stick to that particular process. That gives you the best chance of success, for the next 5 to 10 years. We're not saying that the success is guaranteed, but at least it gives you the best chance for success.
And that's what quant gives us, the ability to do that.
Correct.
Now, when a particular stock, which was like a growth darling, starts correcting, and you know how it starts correcting, right? It's the first one to hit massively. What changes? Is it the earnings trajectory for that company, or is it just the perception of the market, or the sentiment, or P as we call it?
See, generally, like, what we've seen is that it's an overall market sentiment that changes. Specifically, looking at today's case, businesses that were valued at, say, 40, 50, 60 times earnings are now valued at 20, 25 times earnings. So I think it's an overall sentiment change. I don't think so, other than that, a lot of the things are changing. Yeah, overall, there are, the way the world works is that there are macro changes which then affect the economy, which then indirectly affect businesses, and then which will directly affect the market. And that there is a trickle down effect. Yes, like, today the markets are down a lot because of uncertainty. Like, as we speak today, people don't know what's going to happen over the next 2, 3, 4 years. 2024 we were certain of earnings. Today we are not certain of that earnings because of multiple global factors, and that is changing the multiples out there. Now, what's going to happen in the future, nobody knows. What you can control is the price you enter at. So I think so, anyone who's entering at the top is always going to face that challenge. I don't think so we need to complicate it further. You just need to maintain that margin of safety, enter at, good valuations. You're not worried about. That means that sitting out is a very big skill. Like, sitting out, not being a participant in crazy bull markets, that also means that you're going to miss out on some amount of the gains. So, yeah.
Yeah, as I said before, when you separate out the two, the company, and its operations, and then, separately you can look at what price is someone willing to pay for that, or broadly we can call it liquidity. There are a lot of businesses today that, nothing has changed with the business. It continues to grow at a particular pace. Maybe there are global uncertainties, but this company, is not exporting, is not, reliant on, let's say, oil fluctuations and gas fluctuations, all of that. It's possible, but the liquidity has moved out because of the added uncertainty. So I would say these times generally create opportunities. At this point, if you're able to zoom out and, see the entire situation, saying companies unaffected and, prices are affected because of uncertainty, then it just makes, a reason for you to be taking more position in those companies.
Thank you, guys. I think that was very informative, especially for our viewers, on how to not get trapped in these growth stories and maybe, make better decisions in top of a bull market. So I think that was really good. And I think it's time for our next segment, which is Scroll Check, where we pulled out some posts from the social media. I'll be reading out to you guys, as you know. First one is, everyone calling Zomato expensive at 200x P in 2021 missed the point. Revenue tripled, stock recovered, now at 80x, still expensive to value investors. But these are platform businesses with winner take all dynamics. P doesn't work for growth. I'm adding more at every dip. Conviction is greater than valuation.
The idea over here is, not to judge, success for individual stock in this manner. What we have to do is take a step back and, think of it like a portfolio. For example, if there's a value investor, the mandate in their mind is, to buy businesses at better valuations. The idea is, making 15, 20, 25% return with higher certainty on each of those stocks. Now, let's say if you go to VC style of investing, what ends up happening is you're investing in, hyper growth after some point. So let's say if you invest in, 10 companies, you'll see that success only with 2 or 3 companies. It's possible that the remaining 7, 8 companies don't end up, giving those same kind of returns, or in fact end up, shutting down business or giving negative returns. All of that is possible. Now you can make a portfolio with all of these high growth companies, that also works. You can make a portfolio with, just the value companies, that also works. What's important is for you to understand your style of investing. If let's say my style of investing is growth investing, I don't think I'll be able to, pick exact points, for me to enter in a value style of investing, or for me to do a VC style of investing. I don't think that is something that will yield better result, at least for me.
So the second one is India's GDP growing 7% plus, 1.4 billion consumers, digital transformation, manufacturing shift from China. Every structural trend points up for the decade. At these growth rates, any correction is a buying opportunity. Deploying 3 crore into growth oriented flexi cap funds, India premium is justified and valuation concerns are for pessimists.
Basically all these decisions are based on macroeconomics, right? Like what this post is saying is that looking at India GDP and manufacturing, etc. What Warren Buffett says is that when you're looking at macro, he answers this one question where he says that what kind of information is sort of desirable, right? So there are two criteria. That one is that the information needs to be important, which is true for macro information. Second is it needs to be predictable, right? Or it should be knowable. The thing with macro information is no one is able to predict or know what's going to happen in the future. So if you're basing your decision just based on that, I think there's a flaw out there. What you need to go is that, okay, fine, on a macro environment, we know that India is a safe country, we don't have wars, we have a stable government. So that's great and conducive for the economy as well as equity markets. But after that, you need to go in depth in terms of say stock picking, etc. If your idea is just to beat inflation and currency depreciation, great, then having exposure to the markets is brilliant. Expect to make 12-14% per annum. But if your idea is that no, I want to generate higher double digit returns, then you'll have to get into in-depth research. So I think that just basing your decision based on some macro information is not enough to outperform.
Absolutely, and we've faced this multiple times. Just to give you an example now. With the China plus one strategy, a lot of companies wanted to move to India for manufacturing, and that's, I would say, a very good tailwind. But can India handle that kind of manufacturing? When we're looking at the numbers, even after, let's say, the PLI schemes and other benefits given to manufacturers in India, we've not seen that kind of growth. We were looking at the energy sector very closely. 5 years back, there was some projections given about what kind of energy lines would be part of the infrastructure and all of that. And honestly, some of the lines have not even there's no capex on any of that right now. There are also plans in terms of next 5 years, for example, just talking about the railway infrastructure right now. 5 years back, there was a certain expectation that railway infrastructure will be here, but it's not where it was. So understanding that this will help me grow is definitely of importance. But how much of that has actually happened, and basing that how much of this will now happen going forward is very important to do. So as Rishabh was mentioning, very important to get company specific into the details about what is actually happening in this sector or industry right now.
Looking at the execution,
Correct.
that is what would give you confidence.
Correct.
Next question is the best companies are always expensive. Asian Paints at 60 times, Titan at 70 times, HDFC Bank was expensive at every point in the last 20 years. If you wait for cheap valuations and quality growth stocks, you never buy. Just keep adding through SIPs, quality compounds regardless of entry price. I think this is similar to what you were saying, buy at any price kind of.
See, the thing is that it's not buy at any price. What the post is mentioning that doing SIPs, right? I think SIP is not buying at every price. You're sort of dividing your entry
Price,
points, right? So I think that's a great strategy, and I think like more or less you'll beat 80% of the guys out there who are trying to time the market. So if you want a blanket strategy and you are not spending more than say 2 hours a day on this, it's not a full-time job. I think timing is a bad idea. Doing an SIP is a much better idea. You don't know what's going to be the top, what's going to be the bottom. You do that SIP, you'll get a much better price than most people, and you'll also get much better performance. So I think you need to stick by that strategy.
Yeah, absolutely. One thing, to add over here is, so people, again, the idea behind it is people are paying for certainty of revenue or certainty of net profit. That certainty can come from, a stock. It can also come from, debt. For if you end up buying a business at 80 times earnings, effectively your yield is 1.25%. Now, if I was to generate, 1.25%, I can, have an FD in the bank which will give me 6% return. If I don't see a growth in that in the revenues which I'm buying at 80 times earnings, if I don't see that growth at some point, maybe 1 year, 3 years, 5 years, that that number is going to come down, because capital again will start flowing from low earnings yield to higher earnings yield, and it will come and match at a point where it makes sense for both. So it's possible that in the short term you can continue with this strategy, this continues, to make money. But like over a 5-10 year period, you'll see that there always, money keeps flowing from, low earnings yield to high earnings yield.
Right, perfect. I think we can go to the next segment now, which is answering the internet. That's where we've got received questions from our viewers in our DMs, and I'll be reading some of them for you. So first question is, in the current correction, should I add to growth stocks that have fallen 30-40%, or is it still too early?
So I think, Pratik, if you are looking at stock specific, if you're going to add to a particular stock, then it makes sense that, you need to analyze that business. If it's purely based on price, I don't think it makes any sense. There are lots of businesses that are coming at much cheaper valuations, but the reason they are cheaper is because there is no more earnings growth available out there. So don't look at only price, stuff like 52-week low and, enter at businesses that are at a 52-week low. If you're looking at stock specific research, when then it makes sense to enter if prices are much better. If you want to enter because prices are lower, I would say that you do it on an index level, on a mutual fund level, or an ETF level, and not on a stock specific level.
So just to add to this, Pratik, so there's one very interesting, study done on this. Let's assume in a market, when the market falls, there are some stocks that fall 15-20%. And, and in that other extreme, some stocks have fallen 50-60%. A lot of the investors, think, let's buy whatever has fallen the most. But which stocks tend to recover faster and end up giving you better growth? Intuitively, people would think that something that has fallen 50% will go back to 100, and then I'll make the most return from that. There was the study done. I think it was done by Capital Mind recently. I was looking at that particular post. The stocks that have fallen 50%, we realize at a later point that they've fallen 50% for a reason, and those stocks generally don't tend to go back to where they were trading, as compared to there are some stocks that have only fallen 15-20%, that also didn't fall because the underlying business was strong and liquidity never left that stock, because they were still certain of the revenues and net profit of that company going forward. They divided the data into 10 deciles. They saw that the decile 10, which is the companies that have fallen the least, end up doing the best over the next few years in terms of a period. So I'm saying intuitively there are some thoughts that we might have that this might do well, but when you test it for the data last 15-20 years, the picture becomes very clear. So, and you can avoid those pitfalls if you understand how things have worked in the past.
Thanks, Gaurav. That was actually very insightful. So next question is it true that growth stocks underperform value stocks over long periods of time?
So I hear what you're saying. I'll tell you, Pratik, what happens is things tend to move in cycles. Now on the index itself, you can see multiple strategy indices, which break it up into momentum, value, low volatility, and all of that. I would say there are different cycles in which they perform. For example, the last 5 years, the best performer has been value, where it has given close to 30% CAGR, compounded annual growth rate, as compared to the others which have not done as well over the last 5 years. But let's say if I now look at the last 20 years of data, I see momentum has done well as compared to value. So I would say these tend to move in cycles. There are different models that help you predict that which cycle will be for the next 5 years, which cycle is best suited. But no model gives you a 100% accurate answer. It still gives you an important asset allocation answer, saying that you can be allocated to this particular theme, for X amount, and the other theme for X amount.
Thank you so much, guys. A really interesting conversation.
Thanks, Pratik.
Thanks, Pratik.
If this conversation helped you think about growth differently, consider subscribing. And for more such market related insights, hop on to our newsletter.